Canada, a key player in the global oil industry, is redirecting its export focus towards China. This strategic move aims to diversify markets and bolster energy security. The expansion of the Trans Mountain Pipeline supports this transition. Strengthening relations with China is reshaping global energy dynamics. The US-China trade war has upended global energy dynamics, pushing nations to explore new markets. Canada has turned to China, taking advantage of the decline in US exports. China is broadening its energy sources, aiming to lessen its dependence on the US. The trade war is speeding up changes in the global energy landscape. Energy security and diversification have become more critical than ever. The completion of the Trans Mountain Pipeline expansion in May 2025 has revolutionized Canada's oil export strategy. This $34 billion project, which endured numerous delays and legal battles, has dramatically boosted Canada's ability to move oil from Alberta's landlocked oil sands to the Pacific coast, unlocking new markets in Asia, including China. The expansion has increased the pipeline's capacity by 590,000 barrels per day, bringing the total to 890,000 barrels per day. This boost has been crucial in enabling the surge of Canadian oil exports to China. With the enhanced pipeline capacity, Canada can now transport its oil to Tidewater, where it is loaded onto tankers and shipped to markets across the Pacific. The Trans Mountain Pipeline expansion is celebrated as a significant triumph for the Canadian energy sector, which has long aimed to lessen its dependence on the US market. The project has also been lauded for generating jobs and stimulating economic activity in Western Canada. However, the pipeline has faced opposition from environmental groups and Indigenous communities who have voiced concerns about potential oil spills and impacts on traditional lands. The Canadian government has defended the project, asserting that it is vital for the nation's economic prosperity and energy security. China's increasing demand for Canadian oil has led to substantial investments in Canada's energy sector. Chinese firms are actively pursuing opportunities to tap into Canada's extensive oil reserves, understanding the strategic need to diversify their energy sources. These investments come in various forms such as joint ventures, acquisitions, and long-term supply contracts. A significant example is Rongsheng Petrochemical, China's largest independent refiner, opening an office in Calgary in March 2025. This move highlights the growing commitment of Chinese companies to establish a foothold in Canada's oil industry. Rongsheng's Calgary office acts as a central hub for its Canadian operations, facilitating deals and strengthening ties with local producers. Chinese companies have also heavily invested in Canadian oil sands projects. For example, CNOOC Limited, China's largest offshore oil and gas producer, owns a stake in the Nexen Long Lake oil sands project in Alberta. These investments reflect the long-term perspective that Chinese companies have on the Canadian energy market. The Canadian government has welcomed the influx of Chinese investment, viewing it as a vote of confidence in the Canadian economy and the sustainability of the country's oil sands. These investments have not only provided essential capital, but have also strengthened the relationship between Canada and China. Here's Section 5, Impact on the US oil industry, a ripple effect. The United States has taken note of Canada's increasing oil exports to China, which is causing ripples in the US oil industry as it navigates the changes in global energy dynamics. Despite the US being a leading oil producer, losing market share in China, a significant growth market, has sparked concerns about the future of US oil producers. The rise in Canadian oil exports to China coincides with a period of challenges for the US oil industry, including the increasing adoption of electric vehicles and the push towards cleaner energy alternatives. The reduction in market share in China adds to the hurdles faced by US oil producers. The effect of Canada's oil exports to China on the US oil industry will depend on various factors such as global oil prices, US energy policies, and advancements in energy technology. Nonetheless, this shift in global energy flows is clearly intensifying competition for US oil producers. The US oil industry is keeping a close watch on developments in the Canadian oil sector and its expanding relationship with China. Some experts suggest that the US may need to revise its strategies to stay competitive in the global oil market. Section 6, Trump's trade policies, unintended consequences. The trade policies of the Trump administration, especially the trade war with China, have sparked extensive debate and scrutiny. While the administration claims these policies aim to safeguard American jobs and interests, critics argue they have led to unintended outcomes, such as Canada's increased oil exports to China. The trade war, marked by tariffs on billions of dollars worth of goods between the US and China, has introduced uncertainty and volatility into the global economy. This uncertainty has complicated business planning and driven some companies to diversify their supply chains and explore new markets. For Canada's oil sector, the trade war has opened up opportunities to replace the reduced US oil exports to China. The tariffs between the US and China have made Canadian oil more appealing to Chinese buyers. Additionally, Trump's trade policies have strained US relations with key allies, including Canada. For instance, US tariffs on Canadian steel and aluminum have prompted retaliatory measures from Canada, further complicating their trade relationship. Section 7. Geopolitical implications. Shifting alliances in the energy sector. The expanding energy collaboration between Canada and China carries significant geopolitical consequences, hinting at a possible realignment in the global energy landscape. As China aims to secure its energy needs and lessen its dependence on traditional suppliers, it increasingly views countries like Canada as stable, long-term partners. This shift in energy partnerships has the potential to transform global trade patterns and geopolitical relationships. As China's role in the global economy continues to expand, its energy alliances will become increasingly crucial. Nations that manage to establish a presence in the Chinese energy market will be well positioned to benefit from China's economic ascent. The strengthening energy ties between Canada and China could also impact the US-Canada relationship. As Canada enhances its economic connections with China, it may become less dependent on the US as a trading partner. This could potentially lead to a rebalancing of the US-Canada relationship, with Canada asserting more independence on the global stage. The geopolitical ramifications of Canada's energy shift towards China are intricate and multifaceted. It is a trend that warrants close observation as it continues to evolve. Section 8. Conclusion: a new energy landscape. The global energy sector is experiencing a profound transformation, influenced by geopolitical changes, technological progress, and shifting energy policies. Canada's move to boost oil exports to China, enabled by the Trans Mountain Pipeline expansion and backed by Chinese investment, exemplifies this ongoing transformation. Although the $109 billion figure mentioned in some reports is unverified, the trend is clear. Canada is turning to the east to secure its energy future. This strategic shift has major implications for the US oil industry, global trade dynamics, and the geopolitical balance of power. As the world moves towards a lower carbon future, the energy sector will continue to evolve and adapt. Canada's strategy to diversify its energy exports and strengthen ties with China highlights the dynamism and interconnectedness of the global energy market. The effects of this shift will be felt for years to come, shaping the future energy landscape.